Question, what about stablecoin to stablecoin trades?
Where you get into trouble by just ignoring it completely and saying, I don't know how to do this, I'm not going to report it. What if you didn't want an airdrop? What if there really isn't a great market when things are first airdropped?
What is a significant underpayment?
The IRS can come in at any point.
The statute of limitations, how long is that?
Hey guys, it's Miss Vosk here to tell you about Polyswarm, which is a launchpad for new technologies that has innovative threat detection methods built in for user protection. Polyswarm's utility token, NCT, which was just listed on Coinbase, is used to power the Polyswarm marketplace. This is a community and network for detecting malware and rewarding users for generating data. The team behind Polyswarm is doxed, and you can find all their information on their team page. Check out the link in the video description below to learn more about Polyswarm. This is not financial advice.
Hey everyone, welcome back to the VoskCoin YouTube channel. My name is Drew Vosk. I will be your host today. This is Miles, a certified tax expert.
Yeah, thanks for having me.
Today we're going to be running through just all your burning tax questions. We're going to be talking about DeFi, NFTs, staking, earning interest on your coins, stablecoin to stablecoin trades. We're not going to touch too much on mining. We actually have an episode completely dedicated to mining, all with Miles. So if you have a lot of crypto mining questions, we've addressed everything there. We may touch on a couple of things here and there, but if you're looking for mining specific tax information, the other video on our channel is going to be best suited for you. So jumping right into it, looking at our questions here from VoskCoin Talk, our forum, Miles, and I think this is a really good question. What about stablecoin to stablecoin trades? Like, this is a dollar, this is a dollar. It's kind of a weird trade, but you can do it often. I've traded stablecoins to put them in different, exchanges and services and protocols to earn interest, right? Maybe I'm going from USDT Tether to USDC. UST's been very popular recently, among obviously many other stablecoins.
Going to the basics of kind of what crypto activity is taxed, what crypto activity is not taxed. So when you sell your coins for US dollars, that's a taxable event. When you sell crypto for another crypto, you're actually disposing of that original crypto. That's considered a taxable event as well. Moving your coins around from wallet to wallet or exchange to exchange, that's not a taxable event. So when we kind of apply that simple framework to stablecoins, so stablecoins are considered digital assets, considered cryptocurrency, just the same as Bitcoin. So you do have a tax reporting requirement when you transact and trade with stablecoins. There's an easy part of this in that the cost basis in your stablecoins are usually exactly what exactly what they're worth. So typically we don't see any gain or loss. There may be minimal gain or loss from stablecoins because these stablecoins are they do fluctuate slightly at times. Other ways you may have gain or loss is if you include fees. Your fees can reduce your taxable gain, so you may have kind of gain or loss there. So it is important for you to report any stablecoin transactions anytime you dispose of a stablecoin for another stablecoin, or even disposing of stablecoin for any other crypto like ETH or Bitcoin. That's a taxable event, even if you have no gain or loss. And so you're still going to want to report it on your return, even if you have no gain or loss, because that substantiates your holding period for the next coin that you earn. You can get that long-term treatment. And it also just substantiates your basis as well in that next coin that you purchase. And so still really important to report all those transactions.
And so we touched on this in the crypto tax video, but I just want to bring it up here because it really is such a reoccurring question. So we have when we mine coins, right? And so when we discussed, spoiler, when you receive the coins, that's when you get taxed on them basically, right? And we talked about also like how I mine my coins into BlockFi and earn interest on them. And in that episode, you also established that when you get paid out the interest on your coins, that's when I would be taxed on that interest. And these are all falling into the category of digital assets. And so this would, I know if I understand this correctly, it's different than like just your USD savings account and how you pay your taxes on like the interest you earn in that account. And so in that example, like if I had the Bitcoin paid out to my personal wallet and then I transferred it to say BlockFi, I have a taxable event when I receive the coins to my personal wallet because I've just generated them, right? And then I send them to BlockFi, but that's just wallet to wallet in a way, so that's not a taxable event. And then they get there, and I sell them for stable coins because I could earn, say, a higher interest rate, and I want to realize my gains or whatever else. So right there, I have a taxable event, basically, like as you said, disposing of the Bitcoin, and now I'm acquiring, say, USDC, and then that sits there and earns interest. And then each month, I'm getting paid on interest. Those are all taxable events, and basically when it comes time to do my taxes, I need to keep a log of all of this, each event, right? And then I bring this to a professional like you or slug through this all myself and just kind of compute everything and see where the numbers fall. And then that's my tax obligation. And is that all, Miles, your professional review? Am I lost or am I still on the path?
Yeah, I think you are on the path. You're understanding, what events are income events. If you're earning interest, an airdrop, all that type of activity, mining income. That's all ordinary income. That's income that you have to report. Moving your money around, not income you have to report. But if you then, move your money to an exchange, and then sell them or trade them for another crypto, that's a taxable event. It can be extremely difficult to track all this stuff. And on top of that, within the DeFi space, tracking what the US dollar value may be. If you're trading ETH for the Uniswap token, neither of those are priced in US dollar. And it can be extremely difficult to put a US dollar amount on those transactions, which is then what needs to be reported on your tax return. Luckily, there are solutions. There is crypto tax reporting software like CoinLedger where I work, and we have a price engine that does all that stuff for you. And so you plug in your accounts. If you're on Coinbase, we have automatic integration with Coinbase. Plug in all your activity, and we're going to be able to spit out a tax return for you without all the tedious tracking and lining everything up.
You said a word that I want to talk about. Airdrops, right? Airdrops have been popular again over the last couple of years. There's been some really lucrative airdrops. So is that kind of the same thing as the day I received the airdrop? That's what it's valued at? And like how do you deal with that? Airdrops are difficult too because if it's an airdrop of a new token, it's insanely volatile. It could be worth $10,000 that day, go down to 1,000, and then I panic sell at 5 grand, and I'm super excited. But maybe like technically, kind of when I received it, it was worth $10,000. But I'm trying to push a decentralized trade through Uniswap at a high gas fee, and then the transaction fails, and I'm panicking. I mean, crypto is really crazy, and how do I make sure I'm just doing things properly? Because like we said in the last episode, I don't think most people aren't trying to break the law, but it's just kind of overwhelming, and just trying to do things right.
Yeah, overall, airdrops taxation is simple on a general sense. When you receive those airdrop tokens, you have income at the fair market value, whatever price they are when you receive them, that's going to be income that you have to pick up. Now, there has been a crazy amount of diversity within what types of airdrops there are out there. And so just like you spoke on, people are kind of hesitant. They don't know, what they can do to correctly report the stuff. So keeping that general framework in mind, you have income when it's received, you know you're going to have a taxable event from that. And so it's wise for people to set aside, at the time you receive it, set aside a chunk for taxes. Because if the price comes way down, we never know what's going to happen when it's coming time to pay our taxes April 15th the next year. So it's really important to kind of think ahead and save some money aside for the taxes.
So here's a curveball. What if I get airdropped an NFT, a non-fungible token? And in this specific example, it'll just be what people refer to as like a PFP. It's digital art. It's like a profile picture. All right, let's say I get like not actually a Bored Ape Yacht Club or a Crypto Punk, but something similar. But what if it kind of has no value in market, but like it's kind of being traded, but it's what if I didn't even want it? And am I breaking the law if I don't report this thing I never wanted, or that's really hard to even compute a value for?
That's where we see that complexity. It's like on a general sense, airdrop income when received at its fair market value. But you're right, you can get into all sorts of situations. What if you didn't want an airdrop? What if there really isn't a great market when things are first airdropped, especially in some of these kind of NFT iterations? I think what's important there is it's important for everyone to do their best faith effort. Everyone needs to be kind of doing quality due diligence, making sure they understand what the taxability is, and then do their best to try and report it. Where you get into trouble is by just ignoring it completely and saying, I don't know how to do this, I'm not going to report it. You're much better off if you determine based on reasonable methods that you can apply, say, hey, this NFT airdrop I received, there really wasn't a market for it, or maybe the floor price is zero point 0.1 ETH, right? Well then, or maybe you decide it's even $0 at the time you received it. Well, you should report that. Report that even and put in, NFT airdrop $0. Put that on the return. Establish your position on the return. Then it gives the IRS then has a time limit to how long they have to audit you. The IRS can't audit you unless you committed fraud on a tax return from 20 years ago. They have a statute of limitations there. And so by kind of establishing your position on the return, not only on the return that you're filing with the IRS, but it's really, really important to take notes for yourself. Really, one of the best things you can do is take contemporaneous notes kind of week of or month of, and write your intention, write your process and your thinking. So if you then, let's say worst case scenario, IRS comes in, they're saying you all owe all this tax, and you say, look at what my thought process was. I'm not doing anything outside of what I think is in best faith effort, and you're not really going to get into trouble in that sense. You get into trouble by ignoring the stuff, not reporting the stuff, kind of shying away from the complexity and saying, I don't have to report anything.
So you said the statute of limitations. How long is that?
Yeah, it's 3 years typically. If you have substantial underpayment, if you underpaid what the IRS determines you owe, more than 20% underpayment, the statute of limitations moves to 6 years. If, however, you committed fraud and you willfully omitted information, there is no length to the statute of limitations. The IRS can come in at any point. And so it's really important to keep that in mind to do a best faith effort while you're reporting.
And what is a significant underpayment? Is like as you said, is that 20%? So let's say like I paid $100,000 in taxes, or let's say I paid 80, but I really owed 100,000, and so I avoided 20%, and that's significant underpayment. Just to understand it.
That's correct. That's more or less kind of about how it's calculated and done. So yeah, if you're kind of much under, and usually it's not because you're not paying the amount that you owe. It's usually because there's a difference in opinion on maybe one item, or if there's a lot of items and that adds up to that 20% difference, then that's when you kind of get into that 20% category. It's important to think about materiality on this. How much of my total income is this one event? If you start to get into a situation where one event or a couple events that you're not so sure about is a significant amount of your income, it may make sense to talk to a tax professional about your situation.
And so I think my big takeaway here is one, especially just to keep notes. You just keep a little binder and you can always reference it because you're going to quickly forget a year ago, 2 years ago, 3 years ago, and so forth. But if you're kind of in this space, you're going to be always doing things that have a monetary value attached, especially just as crypto becomes more popular. I mean, there used to be a lot of things you could do, and a lot of these tokens were kind of worthless, right? But now, like, so many different projects actually have like substantial value, or they rise and so forth. So I think that makes a lot of sense. So just keeping notes and doing what's realistic good faith, and it's just like if you get audited, it's like, hey, like this is what I did, and here's why, and that makes sense, and I think that will hopefully put some of like the viewers at ease. Is that's a really good takeaway. Is just do the best you can, and don't be lazy. Don't shy away, and I mean that's kind of all you can do, other than consulting professionals and so forth. But as far as keeping notes and everything like that.
That's exactly right. Contemporaneous notes is one of the best things you can do to protect yourself. Those notes, worst case scenario, go do quite well in a court system, and so that can back up your position quite nicely.
Let's say I go and buy an NFT, and let's say it's an Ethereum NFT. All NFTs are really technically tokens, right? It's like you have fungible and non-fungible. Fungible means you can change them out. Like, we have these Bitcoins, right? And the Bitcoin's a Bitcoin. Even though they all have a history, maybe a better example would be something like Monero, right? Where they're supposed to be private, and every Monero is just a private Monero, and you're not supposed to know the history and whatever else. But then you have NFTs, non-fungible tokens, say the Bored Ape Yacht Club, 10,000 unique ones, right? And so I go on OpenSea, a semi-decentralized NFT marketplace, and I already have some Ethereum in my account. And let's say I go and buy one of these NFTs for 1 Ethereum, and at that day, 1 Ethereum is worth $4,000. So I buy one for $4,000, right? And so at that point, I'm turning my Ethereum into an NFT, and this would be a taxable event, correct?
You're correct. When you dispose of your ETH to buy that NFT, that's the ETH disposal. You're going to have taxable gain or loss on that Ethereum that you got rid of, depending on the price you acquire that ETH for. And so that's exactly right. Buying an NFT is oftentimes a taxable event because you're disposing of crypto in order to buy that NFT.
And so in this case, so I paid 1 Ethereum, which is $4,000 in this example, and this is a one of one. So I'm establishing a value of this at that 1 ETH. So is this, just a wash as far as it's not like I bought this and I'm up or down? It's $4,000 and there's only one, so the value can't change until I sell it, right? Because if a different ape sells for a different price, well, it looks different. It's a different token on the chain. Is that correct? That this can't go up and down until I sell it?
You're exactly right. Until you eventually sell your NFT, you're not going to have any taxable event. But that's the case with Bitcoin and crypto as well. The price may go up or down, but all of that is unrealized. And so it's not until you actually sell and dispose of that crypto later down the line that you have a taxable event there. So the two work similarly, just the price maybe isn't as widely exchanged, as not as easy to get a price for the NFTs as it is to get a price for Bitcoin, which is kind of heavily traded on public markets.
So dealing with NFTs seems different, or it could seem different, I should say, but it's kind of not. right? It's just, you buy it for this, and then let's say next year I'm super lucky and price is up huge, and I go from 1 Ethereum, I sell it for 100 Ethereum. And let's just say 100 Ethereum is worth $100,000 then, right? So now I bought in for $4,000 and now I've made $100,000, and so I'm just going to be taxed on the difference, right? And um, and I guess one other question to take that a step further, but let's say I do that and then I send it to an exchange and I sell it for dollars. Do I really? I mean, you technically have a taxable event in between, but you're trying to negate any differences and fluctuation in price. Um, it so would you like the proper way is still to be reporting everything along the way, right? Like, so you sold the NFT for Ethereum, and this is the cost difference and so forth, and then I took that Ethereum and then I sold it for dollars, and this is what happened there, correct?
That's correct. I think the first thing to recognize is NFTs are still kind of considered these digital assets and are taxed as capital kind of assets similarly to Bitcoin or Ethereum. So the tax treatment for NFTs is very similar, if not mostly the same to Ethereum and Bitcoin. And you're exactly right. As you kind of go through all these transactions, you're going to want to record and keep track of those transactions, even if those transactions end up washing out at the end. Each one of those transactions really is kind of like a piece of the story to get from how you started to where you ended for the tax year. And, that reporting all those transactions does yourself a favor in substantiating your holding period and your basis. And, the reality is, all this crypto stuff is taxable whether or not you've kind of then taken out your money into US dollars. And so if you don't take out your money in US dollars, or you do take out your money in US dollars and you have taxable transactions, you still have to report that on your tax return.
What happens if you have more money in crypto than you have in dollars and you have these taxable events? Are you just simply left with a scenario where you have to sell your crypto to pay your taxes? Because you can't be like, hey, US government, can I send you some USDC, or some Bitcoin?
That's exactly right. You're going to have that tax liability. If you're trading crypto to crypto, you're completely crypto native, you have as little money in your bank account as possible, you're really fully bought in. Yes, you're still going to have those taxable events in which the IRS wants their money in cold hard cash. And so, we see that we've been seeing this a lot, come April 15th when it's time to pay their taxes, we've seen like a drawdown in the market. Obviously there's cycles, there's a lot of factors that go into this, but the tax factor definitely is part of this, where people are selling off their coins in order to pay their taxes. And unfortunately, selling off your coins is its own taxable event. And so it kind of creates a cycle. Well, then for the next year, you have to pay taxes as well. We're seeing kind of a use of stablecoins really can mitigate some of this, by setting aside money for your taxes throughout the year, not just at the end of the year or April 15th. You can, set aside the money you think you're going to owe on taxes, stake those stable coins, earn interest on them, and then when you go and sell your stable coins for dollars, any gain or loss is going to be very minimal because those stable coins are pegged to the dollar, and you kind of have that cash kind of liquid ready to go and pay your taxes. And so that will kind of smooth you out, and it will really kind of reduce how much of a burden paying these taxes are.
There you have it, running through the top tax questions and everything else in between.
Well, thanks for having me. Everyone go check out CoinLedger, which has been rebranded from cryptotrader.tax in order to get all of your crypto tax reporting done easily this filing season. Thanks so much for having me on, Drew.
Crypto taxes are scary. They're stressful. They're overwhelming. And they're kind of an enigma. They're always changing. Cryptocurrency is becoming more popular than ever before. which means that the government is going to be paying more attention than ever before. And you should always be reporting, what you're doing, what you're earning. You can never advocate breaking the rules, breaking the laws, right? And in all seriousness, I mean, what you stand to lose versus what you have to gain evading taxes, right? I mean, maybe you get away with it. Awesome, right? You did it. But if you don't, you could go to jail. You're going to get penalized. You're going to pay interest. Personally, I pay all my taxes. I think you should too. Do I agree with the tax code? Do I agree with these high percentages? No, not in the slightest, not even a little bit. However, I'm still going to pay them. That's the situation we're in. If you enjoyed today's video, make sure to slap those links out in the video description below. Get the resources you need to figure out what you need to do, reduce your tax liability the best you can, report everything you're supposed to, and save some money or earn some bonus coins along the way.
When you let me, baby,